How much money should you save for emergency fund? 1,000? 3,000? What about 3 to 6 months of living expenses like many money experts suggested? According to a 2019 report, two economists, after crunching the numbers, actually found a more realistic amount for low-income households specifically to aim for. The number they came up with is $2,467. They argue if you have that much saved, your probability of falling into financial hardship, such as not being able to pay rent, bills, or medical care, is low. The truth is, 40% American cannot even afford a $400 unexpected expense, let alone saving for a rainy day fund. So clearly, emergency fund is very important. But in this video, I want to explain why I don't have my emergency fund, and I want to show you what I'm doing instead and why. So let's begin. Here are my main three problems with it. Number one is that the emergency fund or money saved should have to look at it in the context of other expenses or recurrent debt, such as high interest credit card debts, monthly payments, unpaid collection if you have, or if you have student loans and any other or medical expenses, and those other forms of recurrent expenses. It doesn't make sense to have 3 to 6 months or emergency fund in cash or savings account while having a lot of credit card debts, and that's accumulating lots of high interest anyway. So I prefer to pay down or minimize those recurring debt first, even before considering having emergency fund or building up the emergency fund. And second thing is that inflation, and that's the least obvious and most pronounced problem over a long period of time. Despite the current low interest rate environment, even a $1 in 2010 would only worth about 83 cents today in 2020's dollar term. And so if you have $10,000 set up since 2010, today it would only worth about $8,300, assuming that in cash position. But even the interest savings account, you're barely budge. Consider this: the opportunity cost of not investing those hard-earned cash and savings account into a stock market that could easily earn much higher yields or return. So even just using broad market return conservatively, $10,000 in 2010 investment can easily worth about $20,000 or about $19,672 at a compounding interest rate of 7%, and that's or higher because we're not considering the dividends at all. The opportunity cost would be about $9,000. With that in mind, I prefer to put every single dollar you have to work as soon as possible. Instead of emergency fund in cash or savings account, here are my three alternate options that I recommend currently use. Number one is to use your Roth IRA account as a backstop for an emergency fund. Within Roth IRA account, contributions are not tax deductible, but earnings can grow tax-free and qualified withdrawals are tax and penalty-free, especially if you make the withdrawal taken after age 59 and a half. And 59 and a half is the current law for the Roth IRA cutoff time. However, there are exceptions. So if you're age 59 and under and you can actually withdraw a contribution you made to your Roth IRA account at any time, tax and penalty free, you may have to pay taxes and penalty on earnings in your Roth IRA account. And there are two conditions. First one is that if the withdrawal from a Roth IRA account you have is less than 5 years, then you may be able to avoid penalty, but not taxes when you make these withdrawal for these following situations. One is that if the withdrawal is to pay for a first-time home purchase, up to $10,000 lifetime maximum. And the second is to pay for a qualified education expenses. And third is withdrawal for qualified expenses related to a birth or an adoption. And fourth, if you become disabled or pass away. And the last one is definitely less than optimal. And the fifth is use the withdrawal to pay for an unreimbursed medical expenses or health insurance if you are become unemployed. And I think the last one is definitely very relevant today in the 2020. The second scenario is that if the withdrawal from Roth IRA has been open for more than 5 years and you're still under age 59 and a half, then your earning will not be subject to taxes nor penalty. So therefore will be tax-free and then penalty-free. I'll link down the source below to check it out. And obviously for any kind of taxes related question, definitely consult with your qualified tax advisor. The second option is Health Savings Account or HSA. Health Savings Account is a tax advantage medical savings account available to taxpayers in the US who are enrolled in a high deductible health insurance plan, HDHP. HSA comes with three main tax benefits. The first one is that you can contribute to them on a pre-tax, pre-deductible basis, and therefore you're not subject to a FICA taxes. The second is any interest or investment earning growth tax-free over time. And third, you can also make tax-free withdrawal or payment to cover qualified medical expenses. And it gets better. Unlike most flexible spending account, FSAs, the money in the HSA can actually remain in your account from year to year. And when you end up switching employer or retire, you can actually take your HSA with you. So for the year 2020, you can contribute up to $3,550 for self-only coverage and up to $7,100 for family coverage into HSA. Since it's designed to cover medical expenses tax-free, definitely check a list with your carrier for qualified medical expenses. But this is what I recommend to do. Instead of paying with your HSA contribution every year, you should pay out of pocket first and not withdraw your HSA contribution. Instead, invest every HSA dollar into an investment fund and grow your HSA for retirement for future medical care, considering the fact that medical care are likely going to get a lot more expensive. And the third alternate option for not having an emergency fund, and it's actually one of my favorite, that is to use a margin account with an online brokerage firm that has the lowest borrowing interest fee possible. In my case, I use Robinhood and M1 Finance are two viable options and simplest in my opinion. Robinhood Financial lets you use a margin account and you can borrow up against 50% of your total portfolio value. Let's say you've had $10,000 total investment value at the time, you can then borrow up to $5,000 plus minus the fee, and provided that it will fulfill the margin minimum requirement. And at the same time, with M1 Finance margin account, only available in a taxable account. The margin is only 35%, meaning that you can only borrow up to $3,500. So the M1 Finance is a little bit lower if you have the same $10,000 invested. So at least with M1 Finance account, you have a much lower interest fee at 3.5% versus Robinhood margin interest fee at 5% assessed monthly. While this sounds similar to a HELOC or home equity line of credit, which have similar interest rate, which is 4 or 5%, just depends on your lender or banks. Borrowing a margin on a brokerage firm does not require you to sell your investment for the most part, or necessarily impact your credit score or affect how the lender assessment on your debt to income ratio or DTI. And when used effectively, you may be able to use borrow margin as a down payment for home purchases. Of course, subject to a lender requirement, and definitely consult with your lender. I would caution on any use of margin to make non-emergency purchases or daily, pretty much use that as a piggy bank account for your purchase. That would be a huge mistake and pitfall, and should definitely be avoided at all costs. Another pitfall is that during market recession or when your portfolio value drop below the required investment threshold, you maybe get what they call a margin call. A margin call is basically when your brokerage firm effectively sell any or your partial investment to cover the margin call to basically make that fulfilled requirement again. So all these can be dangerous, but also important consideration when using any kind of margin for that matter, regardless of interest rate to make purchases. While the third option seems like the most dangerous option, when continuing to invest effectively, you can leverage the investment account on margin immediately and make withdrawal or deposit. This is not something you can do if you don't already have qualified HELOC loan or line of credit ready available, because simply when you're trying to apply for HELOC during a market recession or any kind of downturn, it's likely the bank might increase the requirement and make or reduce your HELOC amount, make it a lot harder to borrow, as in the case of currently. All right, guys, thank you for watching this video. Do you agree with my options on why I don't have my emergency funds? Well, comments down below and let me know. And be sure to hit that subscribe button if you're new here. Leave a like if you find this information valuable. All right, stay wealthy and investing. See you in the next video.